Now starting with CI. In CI you have stock split. So in stock split, if it is given 2 for 1, it means that for every 1 share you will get 2 extra shares. So in this case the face value decreases and the market price also decreases. Then we come to the effective tax rate. So effective tax rate, there are basically 3 type of tax rate which you should know about. First one is double tax systems. The second one is split tax rate system. The third one is imputation tax system. So in double taxation system, you have to start with a corporate tax rate. Plus, you have to be mindful about here it is corporate tax rate plus minus the corporate tax rate multiplied by individual tax rate. But in split tax rate system, it is company's dividend tax rate. It's dividend tax rate over here plus 1 minus corporate dividend tax multiplied by individual tax rate. You have to keep this thing in mind. Be cautious in double taxation and split tax rate system. Here it is corporate tax and here it is corporate dividend tax. So one takes the whole corporate tax and the other takes the dividend tax only. Then moving on, we would go with imputational tax system. So in imputational tax system, the effective tax rate on dividend is the tax rate which the shareholder will get eventually. So if the shareholder is in the tax slab of 35%, imputational tax system ensures that the shareholder pays 35% of tax only, not more, not less. Even if the corporate pays an extra tax, it would be adjusted thereof. Then we would go for dividend policies. We have in total 3 dividend policies. First one would be stable dividend policy. Second one is constant dividend policy. Third one is residual dividend policies. So in the stable one, as the name suggests, stable. It is a steady dividend payout even if the earnings are volatile. However the earnings may be, the firm is only going to give $1 per share as the dividend. No matter if the company had earned $15, $20 per share, it will only give $1 a share. It is aligned with the growth rate of the firm, with the long-term growth rate. And it will gradually rise the dividend upon to the target payout ratio which they had set. Important thing in stable dividend payout ratio is that you have target payout ratio. A target payout adjustment will only happen if the current dividend payout is lesser than the target dividend payout. So if it is lesser, then we enhance the payout. So we use this formula over here. Expected increase in the dividend. It is not the dividend which is there. This is expected increase upon years to come forward. Is that expected earnings, what we expect at the end of the year, multiplied by target payout ratio, the whole amount minus previous dividend, and this whole amount multiplied by adjustment factor. The adjustment factor is 1 divided by number of years which the company would like to take to reach to its target payout ratio. So you can summarize the whole thing as E1 multiplied by target dividend payout ratio minus dividend 0, the whole thing multiplied by adjustment factors. Then we move forward to the constant dividend policy. Constant dividend payout ratio is where we expect a certain percentage of our earnings to give for the investor. So let's suppose we allocate 20% of our earnings to be given to the shareholders. That is constant dividend payout ratio. And third and last one would be residual dividend method. So in residual method, it's basically at the end how much the money the firm has. So for this, the firm needs to identify the optimal budget for every project, determine its debt to equity for financing any projects. In this case, the residual dividend over here comes from the residual income. So to get that, it's basically a retained earning minus the equity shares, how much they need for the projects. Let's suppose if the equity share require 10% for each projects for where their amount is employed, and that amount we subtract from the earnings we would actually get. Then we would get the residual income, and from that residual income we are going to give a dividend. So that is residual dividend method. It's as simple as that. Then coming to the dividend policy theories, in total there are 3 theories. First is theory, dividend irrelevant theory. says that the dividend are basically irrelevant and you can make your own dividend. So in cases that if the dividends are high, then you can reinvest the dividend and buy the shares. And if the dividends are low, you can sell the shares and get cash for them. It's basically value is same either way. Next comes bird in the hand. So in that, so investor choose dividend paying firm rather than non-dividend paying firm. It's basically certainty of receiving dividend is much more valued than the certainty of the capital gains by the firm. You have to keep this in mind. After that comes the tax aversion. The tax aversion is if the tax on the dividend is high, then the price increases. You have to keep this in mind. So it's better that the company does not give dividend rather than that the price increases. After that, we come to the share repurchase methods. In share repurchase method, there are in total of 4 items. So the first one is open market transaction. The open market transaction happens in the current market price. So there's basically no obligation to complete the transaction. It's completely flexible. So it is flexible. It has flexible time and it is the fastest way possible. Then we go to the fixed price, where the firm decides on a fixed price and fixed share tender offer. So over here, the company is saying that the firm has the fixed price. It would buy back at 101, which would ideally be higher than the current market price. It is the fastest one, but it does not have any flexibility. You have to keep that in mind. After that, there's Dutch auction. So in Dutch auction, there's a bid. You have to keep in mind there's a bid in Dutch auction. So where a range of buyback prices are given. So between 100 to 110. And the desired number of shares of buyback are shown in the interest. And this, the share and the selling part is quoted on the basis of shareholders. And the company chooses whichever is the lowest bid. This is basically fast, but there's no flexibility at all in this. Then we come to direct negotiation, where another firm comes in and negotiates for the price of the firm. The buyback price, there's going to be a buyback price premium. This could be either a hostile takeover, which could be a greenmail, a legalized way of saying blackmail, but still, where the shareholder could exit, or there could be an LBO, where the management could take over the shareholder, where there is an urgent need of liquidity. This usually happens in the unlisted market. Then we come to the other chapter. So this chapter is going to be cost of capital. You have to know key things. First one is the finance lease. The finance lease is basically RIIL, basically rate implied in the lease, plus the present value of the residual value. You have to keep this in mind. So this basically, the whole thing is basically in the inflow, and the outflow would be the fair value of the lease assets plus the leaser's initial cost. That is the outflow. So these both will always be equal. Then comes the Kroner model of equity risk premium. So he says that equity risk premium is basically a combination of dividend yield plus capital growth. This whole term is basically the capital growth. To make this more intuitive, it's basically the change in price by earnings plus the inflation, which is basically 1 plus YTM of the treasury bond of the normal treasury bond divided by 1 plus YTM of the treasury. Then comes the government taxes. Then we subtract the shares buyback. In this, you have to keep in mind that this share buybacks could be positive or negative. People usually get confused in this. And then we have the risk RFR rate. It's basically equity risk premium is basically dividend yield plus capital gain yield minus risk-free rate. Then we come to the country risk premium. So in a country, how would you find its risk premium? It would be median interest rate of a country minus the median interest rate of the benchmark. This would give you a country risk premium of that country. Then coming to the effect of shareholder on earnings per share. So if the buyback is using surplus capital, there are 2 ways in which the buyback could happen. It could be either via surplus cash or via financing using debt. So in this, there's a key thing which you need to remember. If the buyback is using surplus cash, then the cash decreases, the equity decreases, and the leverage, debt by equity or debt by asset, decreases. So you have to keep this in mind, and earnings per share increases. Over here, if it is financed via debt, so debt increases, equity decreases over here, and debt by equity increases in total. Debt by asset also increases, expense increases, net income decreases because now you're paying more interest, and the number of shares decreases. In this situation, you have to keep this thing in mind. If the interest after tax is higher than the earnings yield, then the EPS decreases. If it is either way around, then the EPS increases. You have to keep this thing in mind. And over here, if the loan interest is higher, then the earnings decreases. And just to recall, EPS basically is net income minus after tax cost of debt divided by the number of shares. After that, we come to the effect of buyback on the book value per share. So here it was buyback on the earnings per share. Now it's basically on the book value per share. So there are basically 2 effects. The first is the number of shareholder decreases, and if the pre-buyback book value per share is lesser than the book value per share, the post BVPS decreases. Just a small minute thing which you need to keep in mind. Then after that we come to the computation of required rate of equity, basically return on equity. So we have, so the first way is the DDM. So DDM says that cost of equity is basically dividend yield plus capital growth yield. So it's basically D1 divided by V0 plus G. And the second one is the bond yield plus risk premium method. In that, cost of equity is the yield of the long-term debt plus the equity risk premium. So this equity risk premium is mostly given. You don't need to calculate this. And this can be averaged out, and it is not much of a hassle. Next one comes the Farmer French. Farmer French is basically KE, cost of equity, is equal to risk-free rate plus beta into equity risk premium. And then you have 5 model, then you have 3 model Farmer French, and then you have 5 model Farmer French. You have to keep this thing in mind, and you have to subtract all these things from the cost of equity. After that comes the expanded CAPM. Expanded CAPM, the cost of equity on the return on equity is basically risk-free rate plus beta of the peer multiplied by equity risk premium plus SP plus IP plus SCRP. And then after that there's built-up approach. So in built-up approach you have to keep in mind that there is no beta. So it's basically cost of equity is equal to risk-free rate plus equity risk premium plus size premium plus SCRP. And this risk-free rate is going to be the large cap company's index rate. After that, coming to the international consideration of equity risk premium. So in international consideration, the country spread, we have to calculate the country spread. In that, we do it by country spread from the developed country. We find the equity risk premium in the emerging countries, which is equal to equity risk premium in the developing country plus lambda. Lambda is basically how much the exposure the developed country has in the local economy multiplied by country risk premium, as we had calculated earlier. And this country risk premium is basically the sovereign yield spread, and that is basically yield of the government sector minus the yield on the benchmark. After this, we come to the international CAPM. So international CAPM basically says it is based on the global market index and on the forex denominated wealth weight market index. After that, we come to global CAPM. Global CAPM is basically equal to risk-free rate plus beta of the global markets multiplied by expected return in the global market minus risk-free rate plus beta of the foreign country multiplied by expected return on the foreign markets minus risk-free rate. This is the global CAPM. Then after that, we come to the one of the most important models, which is Damodaran model. In that Damodaran model, it says that country risk premium is basically the sovereign yield multiplied by the standard deviation of the equity divided by standard deviation of the bond market. So these are the important key factors which you need to understand. Corporate issuers isn't a very hard reading. You can easily go through this. There isn't much to cover.